This is for capital budgeting simulation for HRA 310. In 2014, I had an APV of 589.56. In 2009, I had a revenue of 245.75. And in 2014, I had 337.63. In operating incomes, I had 22.60, and it climbed all the way up to 41.51. In 2009, I had in net income 1356, ending in 2491. So on these charts, my actual stayed in front of my forecast significantly. On the pie chart down here at the bottom, my revenue by division, ahead was production with 233.58, followed by my retail at 231.67, ending with my licensing with 47.57. On my operating profit, my biggest was my license with 24.24, followed by my production with 11.14, and then my retail had 6.13. My total assets, the highest was my production with 187.58, following retail with 86.86, and last but not least, my licensing with 15.34. On the income statement on the company, my net income started in 2014. It was $24.91, and in about a 10-year time span, it doubled to $63.97. None of it was negatives, and none of them dipped, so it was a plus. On the total net assets and the total liabilities and shareholders' equity, it started at 289.77 in 2014, and it ended 422.59 in 2024. Again, none of them dipped. On the production, in 2014, on my net income, it was 6.68. Following in 10 years, it would be 38.82. And every year it added about 3 million all the way up. On my net assets and my total liabilities, it started with 187.58 in 2014, all the way up to 278.22. And again, none of them dipped, and none of them was on the negatives, so that's a plus. On my retail, my net income was 3.68 in 2014, all the way up to 8.36 in 2024. It added about 0.25 every year. On my total net assets and my total liabilities, it started with 86.86 in 2014, and it climbed to 123.40 in 2024. It climbed by about $2 to $3 million a year, depending on the year. On my licensing, though, it started at 14.54 in 2014, and it ended in 16.80 in 2024. About 2015, 2016, it dipped significantly, all the way down to 12% or 12.61, and it slowly started climbing, and it didn't correct itself until about 2021, when we went a little bit over break-even point. On the total net assets and the liabilities, it started at 15.34, ending in 2096 in 2024. This did not break even until about 2017. So it corrected itself in about a 3-year time span. On the cash flow, the total was in 2014 44.3, and it raised all the way up to 88.98, which doubled itself in a 10-year time span. None of it dipped, so it gained about $1 million to $2 million each year. On the ending cash balance, it started at 11.84 in 2014, all the way up to 24.61 in 2024. Again, none dipped. On the production, the total in 2014 was 1902, all the way up to 5501, which about tripled in a 10-year time span, and it climbed by about 2 to 4 million each year. On the ending cash balance, it was 5.56 in 2014, all the way up to 16.19 in 2024, and this climbed about $1 million to $2 million each year. On my retail, in 2014, my total was 9.94, and it climbed about $1 million a year, all the way up to 16.14 in 2024. And my ending cash flow was 3.44 in 2014, and it climbed about $250,000 each year, all the way up to 5.17. My licensing started at 1507 in 2014, ending in 1757 in 2024, and it did dip between 2015 and 2016, went from 15 to 13 in a 2-year time span, and it did not break even until about 2020, 2021. So it took about 6 years to correct itself. On the ending cash flow, it went from 287 to 3.24, and it dipped here, and it didn't break even until about 2021. On my project details, these are all the projects that I chose for the simulation, and these are the remaining projects that I could have chose but I did not. Most of the projects that I chose, probably 2/3, were a high risk, and the remaining third is between medium and low. I did not look very hard at the payback period. I didn't focus that hard on that. I focused more on the NPV and the IRR, and also the amount between the next year and 5 years in the future is how I decided on all of my projects. There was only a couple that I did look at the payback period to make my final decision that if I chose it or not. So starting with the toddler doll accessory line, it was a low risk, and it was also one of my first projects. The discount rate was 7.70, the NPV was 7.15, and the IRR was 25.06. The payback period was 8.7, which is a little high, but again, I didn't focus that hard on that one. And the PI was 11.79. On the toddler accessory line, it did make a steady income. It started at 0.79 in 2015, and slowly rose to 1.27 in 2020. So this is a 5-year time span. It didn't dip, and none of them were in the negative, so it did make a profit. It wasn't a high profit, but it still made money nonetheless. On the ending cash balance, 2015, it was 0.40, all the way up to 0.64 in 2020. So I'm kind of proud I made this one, even though it was a low risk, and I'm tried picking more high risk ones. On Match My Doll, this was a high risk of 9% discount rate. The payback period was about 9 years. The NPV was 6.46 and the IRR was 20%. The PI was 35.23 as well. This one made a profit, and none of it was in the negatives as well. This one was 1.23 in 2015, all the way up to 217 in 2020. So it did slowly rise. It didn't make a very big profit, but it made a good one. There was a couple that I was not proud of in the future, like the new doll film. It was a medium risk, and it had 7.4% discount rate. The NPV was 9.37, and the IRR was 238.61. The payback period was 1.43, and the PI was negative 3.84. The reason I chose this one at the beginning was because the IRR was so high, and the NPV was well over 1.0, and the higher the NPV, the more I wanted it. So these two really sold me on the project. And again, I didn't really look hard on the payback period. But in 2016, it actually stopped making money. So I shouldn't have picked this one, maybe, or probably would have dropped it right here. But it did make a significant amount of money when it was still being bought from 2009 to 2015. The net income was 2.34, and the ending cash balance was 0.4. Even though it's not making any money, it's also not losing any money, so that is a positive on my account. But I would like it to make some money to be kept instead of just kind of laying there. On the electronic toy manufacturer, I was pretty proud about this one. The NPV was 16.34, IRR was 12.62, the discount rate was high with a 9%, and the payback period was about 9 years. The income started in 2015 with a 2.95, and it climbed all the way up to 16.37 in a 5-year time span. So it increased by about 8 times its worth, if I did the math right. And the ending cash balance, 1.75 in 2015, all the way up to 5.59. So none of it's in the negative, and it didn't dip, and it actually increased pretty dramatically over the years. So I'm pretty proud that I kept it, or that I picked this one. It was a very high risk, but I was pretty proud with it. Excuse me, I had to cough. The doll video game, kind of like the movie, I shouldn't have bought it, but what sold me was the IRR 11590. This is the only MPV. This is the only project with the MPV of a 1. Anything, I tried to pick anything that was higher than a 1 or a 2. The lowest I tried to get was probably about a 4. This is the only one that I took a chance on with the NPV because the IRR was so high. And the payback period, I did use the payback period for this one to make my decision, and it was such a low period that I chose it. Looking at it now, it did make a lot of money up until 2015. But then about 2016, 2017, it just kind of stopped. So it stopped about 2018, 2019 actually. It stopped making money. Again, I'm not in the green, or I'm not in the red, so I'm not losing any money, but again, it's not making any money. So that is one that I would probably look back on in the future to see if I would even pick that one. It was just the IRR is what really sold me, and the payback period. These are the updates. A lot of them was pretty good, like the Match My Doll. There was a celebrity's daughter was photographed wearing the item, so the gross margin was higher than expected, so that was pretty good. The Dolls of the World actually was one of the ones that stuck out because the prototype took longer than expected, which delayed everything by about several months. So that one, let's look back at that one. This one was a pretty high risk with a 9%. Had an NPV of 6.32 with an IRR of 19.9. Payback period was about 9 years with a PI of 1.51. It did make an income, and none of it was in the negative or it dipped. It was pretty steady. Started in 2015 with a 1.13 all the way ending in a 2.01 in 2020. And the ending cash balance was 0.56 in 2015, ending in 0.99 in 2020. So it did make money, and even though it slowed down production, it still stayed in the green, and it didn't dip at all. So I'm pretty proud that I picked it. There was a few others that like the Dollhouse with miniature dolls. It launched successfully, but it had lower margins than expected. So it didn't make as much money as we anticipated it would. This one, the Toddler Music's CD series, the revenues from the CDs were twice as large than anticipated, so this one actually made us a lot more money than we thought it would. The Bookstore Cafe made a lower gross margin than what we thought it would be, and the revenues was higher than expected. So it kind of evened it out, even though there was low gross margins, but there was still a higher revenue. And so in 2014, I ended with an APV of $589.56.